Good afternoon, everyone. Thanks very much for giving up some very valuable time today. I'm joined today by Jarrod Telfer from our office. Jordan's one of our senior property advisors and has been with us for a number of years now. He also looks after the client liaison sector of our team as well. So looks after a lot of the property management and the VIP reviews. So welcome, Jarrod.
Thanks, Jarrod. Yeah.
Today we're focusing on the buying in the spring market. So what are the expectations? What's likely to occur through 2020? And obviously it's very different to what we would normally experience in a spring market where we would have an influx of supply. There'd be a lot of choice around from a buyer's point of view. And typically you find there's a bit of momentum building. Whether that leads to price increases is always a question. But there's certainly a bit of enthusiasm around. It's very different this year. So that's what Jordan and I hope to discuss with you today and give you a bit of an overview on things, both from a sales perspective, and obviously that's more around the buying side of things in the spring market. But given that a lot of what we talk about is related to investing in property, there's also a heavily relevant aspect is the rental side of things. So looking at how the rental market has been impacted, we've done a couple of webinars on that, but what it's likely to look like and how it's likely to be influenced by COVID, both from a positive and a negative perspective. So I'll just start by giving you a bit of an overview as to the topics that Jordan and I are going to cover off today. Let me just get this screen up for you. So obviously we'll talk about the two pandemic waves and how they've resulted in restrictions on the property transactions and the rental market. We'll also look at how the property market fared overall during each of these waves. We'll try and drill down on the most and least impacted assets, so what's fared a little bit better and what struggled a bit more and why. The rental market, the differences between the first and the second wave and how that's been impacted. And then obviously from a spring demand and supply point of view, what's likely to occur in the coming months leading up to Christmas, the outlook for prices, and obviously if you are choosing to buy at the moment, what are the best things to do in order to do that in a safe and appropriate manner. So what I thought, and again with another slide to show you, we'd start with is to try and map it out over a graph over the basically since February, March earlier this year when COVID really did kick into gear, and how the numbers that have increased and then decreased and then had a significant increase with the second wave, how that's impacted on the property market, some of the government incentives that have been put forward to try and support both the property market but also the economy in general. So if you look at this slide here, what we've done is divided into three sectors. The first wave, the recovery section in the middle, and then the second wave. Now, we'll look at the first wave first. You can see there that some of the support mechanisms that were put in place are obviously the Victorian rent relief packages and JobKeeper, which certainly support the market. There's the benefit of the two RBA cuts that came about, which certainly helped to support the property market. And then also then there's the negative side of things. So what had to occur as a result of the lockdown procedures that were put in place? So we reverted to online auctions and inspections by appointment only. So we wouldn't know open for inspections, no public auctions out the front of properties. But also evictions were suspended. Now, in a lot of ways, that's a positive, but from a sales perspective, it can be a negative. If you're not able to sell a property with vacant possession, it can really limit the number of potential buyers that you might have. So that's reduced the potential supply that's hit the market. So that's the first wave, and you can see there the numbers down the bottom of the screen on the blue bar graph, how things have progressed. If you look at the second wave there, we can see there that we reverted back to being able to have on-site auctions and open for inspections during that sort of late May, June period. And certainly the numbers dropped. That was when the numbers of COVID cases dropped off fairly significantly. Everything was looking to go to plan. Now, obviously, that's remained the case for the bulk of the country. However, unfortunately, Victoria, Melbourne, more particularly, hasn't done so well. And that's led to the second wave. And you can see there how it really builds in terms of COVID cases. And unfortunately, that's led to some pretty significant impacts on the property market. Obviously, JobKeeper of being extended has certainly helped to support, and the rent relief package, which was only announced, I think it was last week, Jordan, that that's to be extended until the end of the year. And you combine, sorry, go ahead.
Yeah, a couple of weeks ago.
Yeah. So, and then obviously the negatives we've had to, initially we reverted back to our stage 3 lockdown of only online auctions and only private appointments. But then with the stage 4 restrictions, it's really put the property market into hibernation mode, because without the ability to inspect properties, particularly from a sales perspective, it's meant that buyers have just dropped off, and vendors the same are not prepared to sell at the moment because they're not getting the competition. Now, the rental market, which Jordan will expand on in a few moments' time, is slightly different to that, and there's still been the ability to get some engagement in that space. But that, hopefully this just gives you a bit of a picture as to what's happened and some of the issues that have faced the market, and how the market's trying to deal with those. So when we look at this, I guess there's two segments to the property market. There's the sales side of things, and there's the rental side of things. And we want to look at how COVID's impacted on both of those, and then particularly from a rental point of view, because that is part of investing in property, what's likely to happen through the coming months, and then obviously into next year. So we might start with the rental side of things, Jordan, and have a look at how that's been impacted. So if you'd like to, given what you've experienced, particularly through the first and second waves, how things have changed, and what sort of things have been going on within that rental space.
Yeah, it was I wouldn't say business as usual throughout the first wave, but it was the property managers were able to get properties leased, and there was really no impediment. It was a case of it probably at its deepest before stage 4 kicked in at the start of last month. The worst it got was property managers unable to make the usual 10 or 15 minute Saturday open for inspection times, and having numbers of parties through it. It went to private appointments being made, and they were able to work around that, as selling agents were, by just allocating certain amounts of time for people that had pre-registered. So it wasn't really gummed up. We've seen it significantly different though since stage 4 restrictions came in, and with only a couple of exceptions where there were properties, say settlements on foot, where there needed to be some inspections to finish up the tenancy, so condition reports, and for the release of bonds, etc. Property managers haven't been able to set foot on site for any of the properties that they've got on board, and by extension, prospective tenants haven't been able to as well. So it's really ground to a halt. Now, we'll probably see in the last week or two, or probably this week actually, I'm speaking to a couple of property managers, it's starting to now, it's starting to move again. I think people are at the full expectation that this Sunday there's going to be some hints that there's going to be some easing of the restrictions Sunday week. And I think that's now got a few people moving, tenants moving with a bit more confidence that, okay, we can start to register interest for the inspections. May not be able to get through, but we should be in a position where we can actually make a move in the next few weeks. So it's been quite heartening. There've been some properties through a couple of our property managers that we work with pretty closely for our clients' properties, having been able to lease at reasonable levels, just off photos, floor plans, video walkthroughs, that sort of thing. So there's ways around it, but no doubt it's just ground to a halt by and large over the last few weeks. So the second wave has really hammered things. It's also resulted in more requests for rent reductions from existing or sitting tenants, if you like. We saw a bit of a spike as expected early days, so March, April, as things were really starting to hit. And then there was a bit of a period there where I wasn't talking with clients, which was pleasing, around that request for some advice and assistance when they've been hit with a request for rent reduction. So it all went eerily quiet there for a bit, but the last few weeks, absolutely, I think it's really come through again, unfortunately, as more industries have been forced to close down, and that's created a lot of difficulty for a lot of tenants, understandably. So it's no doubt, as a lot of industries have felt, the stage 4 restrictions have really hurt things for sure.
Yeah.
Yeah. What I'd like to do though is I think what we need to do is backtrack a little bit too on. Some of you may have attended or viewed the webinars that Jarrod and I did a few months ago, and that was really around the rental situation and where things are at, and what to do when the inevitable requests come through from tenants for rent reductions. Things have changed, as Jarrod alluded to a few minutes ago, over the last couple of weeks. Now, what they basically amount to is certainly an extension of the moratorium on evictions until 31st of December. That was supposed to have finished up at the end of this month. But with that has come the extension of the temporary rent reduction scheme for those tenants facing rental hardship. But instead of $2,000 with this rent relief grant, it's been increased to $3,000. So for any new applications, and anybody that has received their $2,000, the tenants, that's also being extended to. They're also able to avail themselves with the extra $1,000. So, so that's pretty significant, which is good. Insofar as landlords are concerned, they've increased the. Landlords were eligible for a 25% land tax deduction. That's increased to 50%, provided they enter into a rent reduction agreement with their tenant with a 50% or more rent relief. As we've spoken about previously, though, for most of our clients with residential property, particularly those owning apartments, it's a very small bonus, I suppose, or relief for landlords in a residential property sense. So it's not overly material, but that's been the main change. Other than that, tenants in hardship can still break their lease without penalty, so that continues on. And the freeze on rent increases continues through until 31st of December. That being said, we're not in an environment where rental increases should be expected in any case. So that doesn't hold an awful lot of relevance there. So that's just to follow up on previous advice that has changed over the last couple of weeks, and a few changes there. So things get kicked down the road at least until the 31st of December. So so that's the main update, I suppose. In terms of market rents or rents, where are they at? Well, they're broadly speaking, what I'm finding is around about 20 to 30% for apartments. It's come off that much. Okay. And what I mean by that is landlords whose 12-month lease from, say, a year ago is coming up now, and or perhaps a couple of months ago, property managers would have been entering into negotiations with the existing tenant. There has to be an expectation that things are pulled back by that much. Pretty much across the board for apartments. Houses haven't seemed to have been impacted quite as much. It might be more 15 to 20, 25%. But it is really property specific. We can't throw a blanket over it and say that is across the board the impact. A good example I'm finding, or situations compared to the apartment market, it's not homogenous. If you're looking at a studio or a very, very small one-bedroom apartment, for all sorts of reasons, they are really struggling. But a two-bedroom apartment or a large two-bedroom with a dining room, or maybe even a three, the feedback we're getting from property managers is that they're not as impacted because of the need for, particularly people sharing apartment space, to have their own space for working from home arrangements. It's dawned on us all that this isn't a temporary thing. This is going to last at least until Christmas for a lot of people that can work from home. That's going to continue. And to have that extra space to move into, get some segregation, some quiet space, that's resulted in a number of people coming out of one-bedroom apartments and into two. So it's not across the board that apartments have just been flogged. On the other side of the coin, houses. I was speaking to one of our property managers just yesterday, and she made a good point in that houses that are struggling a bit are probably those that have traditionally appealed to a share house situation, where you might have three people, each paying a couple $100 a week, $250. They might have all been impacted at once, and are now struggling to meet their rental commitments. Or people might be going their separate ways and moving into cheaper accommodation elsewhere individually. So those that are more share house arrangements in terms of houses might have been probably more impacted. Standard little houses though, with a couple who can each bring an income to it. If one, there's a sense of insurance there, I suppose. If one party has their salary reduced or cut or what have you, the other party can make up for that in a little bit, and they can get themselves through. So not everything is being impacted to the same degree, but broadly speaking, there's got to be an expectation that things have come back fairly significantly. Hopefully that bounces though next year, and particularly if we can see some way out of this.
Is it with the reduction in the apartment sector? Are you finding that it's, or from the discussions, is it apartments generally, or is it more modern apartments, or is it older style apartments, high density, lower density?
Yeah, it's been pretty well documented, hasn't it, that those core inner city apartments that have had exposure to students, Airbnb, perhaps tourists, used for tourism purposes or short stay purposes, they've really been impacted, and that of course flows through that sector of the market. As they become vacant, they then oftentimes get thrown onto the standard market, if you like, the standard leasing market, which creates more supply. The demand is decreasing at the time supply is increasing. So that's been at the forefront of those apartments that have really suffered. There's a bit of I find a bit of a flow-on effect to those which you would regard as more bulletproof properties. So as you say, Jarrod, those older style properties, those that are on the city fringe, not right in the heart of it, those in smaller developments, those that have all of those attributes that we've always sought after for our clients in the purchase. They've been not immune, but certainly not nearly as affected. They're finding tenants, but again, there's got to be an expectation of rent reductions, and look, tenants are they're fully aware of that, and had in recent days some fairly interesting examples of tenants trying to negotiate pretty hard on leases on some of our clients' properties. Some reasonable, some I think that are more than ambit claims, but yeah, it's permeated through the market, but certainly that core inner city high-rise multi apartment market is struggling. Yeah.
Okay, no, that's good. We'll move on to the sales side of things. Now, I note in some of the chats there that there does seem to be a bit of background noise. I'm hearing that as well. So we'll try and do that. Both of us will, Jordan, just try and mute when we're not talking to see if we can get rid of that. I'm not sure what's causing it, but we'll try and stop that. And thanks for those that have put some questions in, because I did mean to mention that at the start. We will leave some time at the end of the presentation to answer some questions. We've had some that were given to us before today, so we'll certainly address those, but also keep them coming through during that chat session, because we'll certainly try to address those. So Jordan's spoken about the rental market coming forward and how that will, and that's obviously a factor when it comes to buying an investment property. But let's look at things from the sales side as well. And what I've got here is a slide. Now, what we want to talk about is the volume of property, and normally that's what we would expect during spring, as I mentioned earlier, that supply really kicks into gear, and the volume levels that we would normally expect. So if we look at this this slide here, just to give you a bit of perspective on that. There we go. So what I'll do here is I'm going to put this up in this slide will build, so you'll see it in stages. So the first one there, that's the auction volumes for 2020 versus the auction volumes for 2019. So the number of properties that have hit the market through both years. So, and it's generally pretty consistent in terms of the supply. So you can see that at the start of the year, certainly that dip there is based around the Labor Day long weekend. And then you can see for that as a result of 2019, and it's important to recognise that the first half of 2019 needs to be viewed as a year of two halves. The property market for the first 5-6 months was very, very flat and very, very quiet. And you can see there that it was quite low. We had another dip here. That's Easter. So, and that's again not unusual. But once you see that we get to around July, August, these numbers are really starting to lift and the supply is really starting to pick up. And that happened quite a bit, and it continued the momentum on. And that leads us to the start of 2020, where we were experiencing really strong volumes up at 1,600. We had a dip again for Labor Day, which again, as I said, is not uncommon. But it got back up and we were seeing really strong volumes. The momentum was really kicking into gear for 2020. But then we had this dip. Now, that dip there again is Easter. But normally you would expect, as you can see with 2019, it starts to build again. It dropped because any campaigns that were to commence at the end of March to have auctions in middle of April were withdrawn because that's when COVID really kicked in. And you can see there, even though we were significantly above 2019 to start with, we're now well below it in May and then in June. And then you can see the volume started to build again when we came out of the first wave, and things were looking relatively positive, and people were fairly confident that the market was going to recover. But we get into July and things have started to come backwards again, and now we're well and truly below where we were last year. So it starts to paint a bit of a picture. Now, you don't want to view the volumes on their own. You need to look at them in conjunction with the clearance rate, because that starts to paint the picture then of the demand levels and where that sits. So if we look at the clearance rate and we put that over the top, the first one is the clearance rate for this year. We probably should have had that the other way around. The dot points at the 2019 clearance rate. But again, looking at it in the year of two halves, it was fairly dormant in the first half of 2019. Typically what we look at with clearance rates is if the clearance rate is sitting between or below 50 or below 60%, we're typically in a buyer's market. If the clearance rate's sitting between 60 and 70%, we're in a fairly balanced market. And if the clearance rate is getting up in excess of 70%, we're certainly in a seller's market. So you can see there that the first half of the year we were very much in that buyer's market. It was sub 60%, and it was very much in favour of the buyer. And then as the year progressed, we had the election in May, which was certainly the turning point, and that started to lead to some momentum. And that clearance rate really starts to build as we get through August, and that continued on through the spring. Now, normally the spring market sees the clearance rate come back a little bit as that increase in supply outweighs the demand, and it starts to balance off. That didn't happen last year, and the market was very strong all the way through to Christmas. And then that continued on, as you can see here, the solid blue line into 2020, and the clearance rate was again very good until we got to the end of March, when COVID really started to have an impact and businesses started to suffer. We see that reduction there, and then it continues to drop down in line with COVID impacting the market. Now, the interesting thing here, though, is that you can see this spike. So they almost go in opposite directions. The clearance rate versus the volumes, and you can see if you look at that solid orange line, when it comes down and the volumes drop, which is what happened around May because the confidence wasn't there. Because the demand there was still a little bit of pent-up demand that was there, people that hadn't been able to buy. When the market opened up a bit around that May part, the clearance rate started to rise. So the demand was still there. It's just that the stock wasn't. And that's certainly what allowed prices to continue to hold reasonably firm through that first wave and through that intermediary period. But as soon as the supply starts to pick up here, when we got out of the second wave, the clearance rate starts to come back again. Because the supply was outweighing that demand. But again, then we start to see the supply come off because the second wave kicks in and things are really starting to suffer. And then all of a sudden the clearance rate starts to rise again. So you can really see how they work together, and how you can, if you read them in conjunction, you can really see how it gives a bit of an idea on what the market's doing. Let me get rid of that. So it's just a really interesting an interesting fact to look at and to get a bit of an idea as to what the market's doing. Jordan, I'm not sure if you've got anything you wanted to add to that in terms of and then what our expectations might be for values going forward.
Yeah, I think that that inverse relationship is always plays out, and it's interesting when you track that through with that original slide that you had there on the three periods, Jarrod, there that really coincided with confidence as well. When we all thought we had it beat, or at least under control, And those that hadn't purchased in the early part of the year were still motivated. Stock levels have certainly dropped away. So that saw that, as you said, that saw that clearance rate increase. But I think there's an awful lot of confidence around as well, confidence that plays into it. And that obviously then impacts supply and demand from there. And I think going forward, it's in the short term, what I'm hearing is that there's stock ready and raring to go, normal spring. Now, obviously, agents are probably some of the most optimistic people you're ever going to come across. And what I've been hearing is that, they're just waiting for that word that, okay, things are going to pull back, at least to stage 3. Inspections can recommence, and away we go. And there could be an element of that, but I think also there's an awful lot of confidence of people being battered around by this second wave and are a little bit reluctant to either list their property or to dip the toe in the water and actually get in there and buy. So it'll be fascinating the next couple of months to see what eventuates.
You mentioned there, Jordan, about the different waves and how they sort of line up with movements in the market and what's happened. This slide gives a fairly good indication of that too. You can see there that the market was really strong at the start of the year. And that was off the back of the second half of 2019, where we had some really, really good growth following the sort of 18-month to 2-year period of downturn that we'd experienced. And that really was recovered pretty much in the second half of 2019. Everything that was lost the previous 18 months was recovered fairly quickly over the end of 2019 and the first 2 or 3 months of 2020. But you can see there that as soon as we hit the COVID wave here, the prices have started to come back, and they're continuing on that trend. It's then a matter of how long that's likely to continue for. Having said that, I mean, you look at those price reductions, given some of the talk that's been around, it's not massive and it's not significant. It certainly wouldn't have lost what was made up last year yet, I don't believe, and certainly not with what we've seen. So, I mean, that we're not through it by any stretch of the imagination. There's still a long way to go. But we'll show you a little bit further along that there's still absolutely hope there that, and not hope, expectation that the market's going to, once it does get through this period, that there will be some levelling off for a period first, but then some upside in the years to come. Whether it will be significant upside, well, that will depend on many other factors that need to be taken into account.
Yeah, it's the supply as well. I mean, a lot of that pain was minimised, I suppose, by that drop-off in supply. So if it's a normal spring, and I don't expect it to be, but if it's a normal spring with at least 2 or 3 weekends, a packed October and 2 or 3 weekends at least of 12, 1,500, maybe 1,800 auctions a weekend, then that will be a different story. I think that things could dip away even faster. But you then drill down and say, well, what would motivate people to be putting their property on the market? If they're not confident that there's going to be a buyer out there, and they're not forced sellers, they're probably not going to. So it's probably for the medium term, it's going to be, are those people that are would like to sell but don't have to, do they turn into forced sellers? And that will be something to watch.
Yeah. So if we want to have a quick look, I'll have a discussion now about the drilling down on things in a little bit more detail. So we always talk about the property market not being homogenous, and that's both from a sales and from a rental point of view. You mentioned earlier about the fact that there's differences in value drops in houses versus apartments. But let's talk about the sales side first, so the capital value side of things and the differences. We've certainly seen that, and particularly during that, the interesting part was that middle sector where we did have that consolidation period. And there were plenty of auctions that you and I and the other team members at Wakelin attended where there was strong competition. And there was quite a common theme to that. They were predominantly properties that were sitting in the sort of sub $1.5 million bracket. They weren't just houses, they were apartments as well. But they were properties that had multifaceted demand. So they weren't heavily reliant on just investors, albeit that there were investors that were looking at those properties. But the stronger buyer profile that we probably saw during that period, and what we probably expect to see continue on once the ability to inspect properties and transact property again comes back, was definitely the first home buyers or the young couples, whether they might have been upgrading from a first home to a second home. But certainly that seemed to be the strongest market. You'd agree with that?
Oh, absolutely, yeah, because I'm always curious. When we go through properties, we tend to quiz the agents. What's the buyer profile like? Because that just give you an indication as to the demand now for that particular property, but also potentially going forward, and what they're finding in the market, being at the front of it. It was pretty. It was no, I wouldn't say rare, but most properties that we'd be looking at, they're just the investors weren't there. It was being driven to good levels by, as you say, Jarrod, home buyers. So whether they be as first or perhaps younger second, downsizers as well is a big factor in the house the owner occupier market. But those that were investors, the agents would be saying, oh look, there's a couple sniffing around, but don't expect them to be that putting their hands in the air on the weekend. So which is interesting, because normally you see price rises come on the back of that competing demand between investors, as we've seen probably 10, 15, 20 years ago with owner occupiers, but it was being sustained pretty well by just the owner occupier market earlier in the year.
Yeah, and I mean, you made a comment to me or in the property meeting yesterday in our team meeting about median house prices and how they sometimes get a bit skewed. And we've got to look at some statistics, and certainly the numbers that we put up before in that previous graph were around that. But they can get skewed, can't they, when certain sectors of the market, particularly say the premium sector or the higher value properties, if there's not as many transactions occurring and there's one or two that occur within that space, and they do have a significant drop, it can really start to skew the value.
Yeah, absolutely. It's sort of there's two elements to play. There's that sector of the market, which again, from a lot of agents were telling me that's the one that was suffering. And interestingly, that's premium sector, if you like. Also, in my valuing, when I was valuing 10, 12 years ago, that was the sector that was pulling right back as well. Couple that with generally low volumes, and that can have an outsized impact. So again, it's just it's median values and median prices are always an interesting starting point. But again, to throw a blanket over the market on the basis of that is probably missing a bit of vital detail as well.
Particularly when, as we said before, it's not homogenous. And there's certain sectors that have performed better. I mean, I know that another area that's probably struggled a little bit is the middle ring suburbs, where and they do quite commonly have significant spikes when the market goes well, but they also have fairly good contractions when it doesn't. And not all middle suburbs, but the type of property where the improvements are adding minimal value. So it might be in the middle ring suburbs where there's 1950s, 60s era houses, which are still very livable, but a lot of them in recent times are being demolished for townhouses or for a single larger dwelling. And when there is a strong demand for that, can be from overseas buyers, but they can also be from particularly developers. And if they're not in a position to be able to do those sorts of developments at present, then that market really does drop off, and it can have a considerable change. And I've certainly seen that in a number of sectors in those middle areas. So that's always interesting as well. If we look at the rental side of things, and you mentioned before that in some areas it's been as much as 20 to 30%. Again, some areas have suffered more than others, and certainly from the conversations that we've had with both property managers and our own experiences, not that we buy this type of property, but that high-rise sector in and around South Bank, Docklands, that sort of thing, where it is heavily reliant not only on overseas visitors from a holiday perspective, but also from students coming in and looking for that as accommodation, but also Airbnb accommodation. So all that leads to an increase in supply, and some of the vacancy rates that are being put around in those CBD and South Bank, Docklands type areas are quite significant. I mean, I've heard them up at 16% in some areas.
Yeah, I think the old chestnut was 2.5% to 3% was the market in balance, wasn't it? So it's significant. Yeah. Yeah.
So and again, we found that the housing, and the interesting thing that I've heard from a couple of the property managers that we deal with tenants that are moving out, and the different waves and how the market's been impacted. So for the first wave, there was light at the end of the tunnel. People felt as though they could survive the 6-week period, 8-week period, and then come out the other side and still be able to get back to normality and perhaps get back to work. But when the second waves come and people have realised that, no, they are going to have to stay at home for longer, and not just during the stage 2, stage 3 lockdowns, but potentially until Christmas, people have started to think about, well, is an apartment going to be appropriate for me? And so can I stay in or myself and my partner or my other housemates, can I stay in this property and continue to work from home for a longer period than, say, 2 or 3 months? And people are having second thoughts on that. And with the ability of being able to get out of a lease without any repercussions, people are taking that and looking for alternates. And that's potentially why the housing sector may not have suffered as much from a value point of view as, say, the apartment market has.
Yeah, for sure. Whether it's appropriate to talk about it now, Jarrod, but I also think it's worthwhile having a chat about some of the things that our clients, particularly as this is aimed at, can do to be proactive, I suppose. And it's not all doom and gloom, particularly when you're looking to lease a property out. Property managers have gotten really creative over the last month or so. And a lot of them have done a really, really good job. So some of the I'll just have a look at some of the little notes I've quickly jotted down. What we're suggesting in consultation with the property managers is let's get ahead out of the idea that it has to be a 12-month lease. Sometimes we can achieve what we want to achieve by a shorter term lease, so be it 6 months. And particularly a couple of months ago, that was the advice. You don't necessarily advertise a property for a 6-month lease, but be open to it, flexible lease terms. And we can open up the market. We could potentially get the property to expire, or the lease to expire, in what is traditionally the best time of year, so January through to March of the new year, which is good. A lot of tenants are also uncertain about their position, and they'd welcome a 6-month lease. They may leave after that. If they do, well, at least we've hit the right time of the year. Or their position may strengthen or stabilise at least, and they may look to stay on, remain on, sign an extra 6 months or 12 months from there. So don't be afraid of that. Flexible lease arrangements is one thing that's been able to backfill a number of our clients' properties by just keeping that open mind. The other thing to do as well is, I think traditionally property management hasn't kept pace with, I suppose, sales in the way the properties are being marketed. It was often a case of, well, just a few photos taken on an iPhone, thrown up on the website, the agent's website, and that's always enough. Well, it's not anymore. And I think that what we've found is that those properties that actually have some appeal, you can present it in a great light, they're going to get their nose ahead. So what I mean by that is, a vacant property, and more often than not, properties are vacant. That's why you're looking for a tenant. It's vacant. It can look pretty soulless. A vacant couple of bedrooms and a living space. Virtual furnishing has come a long, long way in the last couple of years, and sometimes it's very hard to tell actually the difference. Whereas a few years ago, you could see that it had been plonked in there and it looked a bit artificial. It's not overly expensive, and remember those photos can be then retained for the next vacancy. So it's not a cost that needs to be replicated each time your property falls vacant.
But particularly at the moment, I mean, those sorts of little things, which, as you said, can be used on an ongoing basis, but you've got to take absolutely every advantage you possibly can at the moment to successfully lease, or if you're going to sell, to successfully sell with whatever you can do. So every little advantage that you can have, and if that's as simple as a few $100s on some virtual furniture or a floor plan, I mean, that's one of the most valuable things I think you're about to mention. But it's the first thing when we look from a buying point of view. The first thing I do is not to shoot through the photos, is to go to the floor plan, because you can tell very quickly whether or not it's going to be a relevant property, or whether or not we're going to look at it and say, no, there's no natural light to that second bedroom. It doesn't have an external window. We're not going to consider that. So the floor plan can make, and from a rental point of view, it can just give some perspective for people.
Yeah, and particularly with people stuck at home. People can't get out there, as you said, they can't get out and inspect, not allowed to. So to be providing good photographs, floor plans, and particularly, probably the horse is bolted now, but if we end up in a similar situation, a video walkthrough. And again, I was talking to one of our really good property managers yesterday, and just yesterday, a couple of our clients' properties had come on only in the last couple of days, already received some applications but she'd been shown some really great initiative and proactively gotten in there, above board, obviously, to take a video walkthrough a number of weeks ago. So that obviously has helped get those applications through. So yeah, it's really important to take every advantage that you possibly can and just stick that property ahead of the others to get those properties leased as quickly as possible. Not just accept that because we don't have access for the next couple of weeks, we can't do anything about it. So there are lots of ways.
Okay, so let's have a look a bit more from an outlook perspective, given that we wanted to talk about the buying side of things for the spring market and what our expectations are to start with from a value point of view, where things are going to be more impacted than other areas, and what our expectations are. And I think a good starting point, given that the bulk of Australia hasn't suffered like Melbourne has. So to take a bit of an indicator as to what some of the other capital cities around the country have done coming out of COVID in the first wave. And so perhaps to give a bit of an indicator as to how we may come out with our second wave, so to speak. Now, obviously, because Victoria and Melbourne more specifically, again, has been far greater impacted with obviously the number of cases, but also deaths. It's been quite significant compared to other areas. It's more likely that it's going to take longer for us to recover and come out the other side than it has for the other cities. But there's still certainly absolutely light at the end of the tunnel. Now, if you look at these are the trajectories of monthly price change for 2020 for the main capital cities around the country. Now, you can see Melbourne there, the black line at the bottom, and has suffered the most and continues to, and will most likely for another few months yet. But if you look at it there, you can see around everything started from around March when COVID became apparent. Around May here is where things start to change. I mean, they're all on a very steep downward trajectory until about May when we hit the coming out of the first wave and things started to look positive. They don't go upward, but they start to level off. And by the time we get to June, the other states are either on the up, so Adelaide on the incline there, or starting to level off. And then as we move now towards July, August, where they've consolidated, the numbers are actually starting to improve and get up towards zero in some instances, and even above. Melbourne's continued down. But you can actually see that after a couple of months, things have started to look quite good once the management of the virus has started to be consolidated and businesses are starting to get back to some form of normality. By no means what we were, but certainly some semblance of it. Now, you'd like to think that Melbourne would be on a similar trajectory to that. So it might take a little bit longer because we have suffered so significantly. But I'm probably expecting that it won't be this year that we'll have that level off. But I think by the time we get into 2021, things will find a balance. And I do think that there's some scope there and that things will start to improve. I don't know what your thoughts are, Jordan, around all of that.
Yeah, there's probably two things. First of all, just to hark back to what I mentioned earlier, it will really be, as it always is, it boils down to the supply and demand. Now, on the demand side of things, I'd probably be having a look at what the finance figures are looking like, because that's a pretty good leading indicator. Obviously, it's pretty self-evident.
Borrowing numbers and things. Yeah.
To see if those buyers can be replaced. Those buyers that we were seeing putting up some good competition back in that, after that first wave, whether they're out of the market and they've exhausted, and whether they're going to be replaced. So on that side of things, that will be interesting to look at. And then the supply side of things is probably a bit easier to try to forecast, I suppose. So there's that. But what I also find interesting to compare when things started to turn down, it was after some real impetus in the market from spring last year through to January, February, right up until the last auction weekend of March. And then it really fell. We saw that. But it was a strong market that we'd entered this downward phase. Now, if that was 12 months ago, if we picked this up now 18 months ago and said, well, okay, this all impacted at the start of 2019, it might take a lot more a lot longer to get out of this this funk that we're clearly in, because the market was flat to declining back in the early part of 2020. 2019. So at least we entered this with some sort of momentum behind it. Now, whether or not whether this second wave has just absolutely squashed that, we'll see. But yeah, I'm never surprised at whichever way it goes. Whenever you think that we're in for a period of downtime, the number of times we've seen over the last 20 years, it's just unexpectedly bounced. And you go, where did that come from? And we saw that after the GFC. We've seen it. We probably weren't expecting it after the 2 years of flat to declining conditions from spring 17 to spring 19, I suppose. But in hindsight, it all makes sense when you sift the tea leaves around a little bit. So we'll see what happens. But
I go back to those capital cities too. The interesting thing there, I mean, Sydney's always probably the most comparable to Melbourne just in terms of the way the auction campaigns and things work there. I found it interesting that I think it was a couple of weeks ago now, there were 668 auctions. So in terms of volume numbers that were on in Sydney that weekend, the same weekend last year for 2019, there were only 446 auctions. So it was actually 200 odd up. Now, you'd argue that there might have been a bit of pent-up supply, and that's probably true, but still it's a positive sign. But the even more positive thing was that the clearance rate was at 68%. So if you're getting a clearance rate up at those sorts of levels, with an auction volume number that's 200 above what it was the year before, it's a positive sign. And so I think there's certainly some momentum that's there. It's not to say that prices are going to jump and go up significantly, but to consolidate and then on the upward incline is certainly possible and probably likely. It's probably just not as likely to be as soon in Melbourne and Victoria, which gives buyers the option to get themselves prepared. And that's probably what we get to now is coming into the spring market and what to do and how to buy. And I mean, I would say that it's absolutely an opportune time to be buying, and that might sound a little self-serving, but I think it is. But I think you've got to be very careful around prices that you're going to pay at the moment. You've got to feel as though you're getting value for money. And if you don't feel as though you're getting that at the moment, then you take a step back. It's not to say that you have to pick it up at a bargain price. It's got to be a bargain. But by no means do you stick your neck out and start paying premiums at the moment. You find the right property, you select the right asset, and then you make sure that you're getting it at a good price. You'll have to compete for it, though. And I mean, again, that's why I come back to that point of what we saw back in June when people were thinking that even then that the market, there's going to be bargains to be had, I'll go out and I'll pick something up. They just weren't. They were absolutely, the values were still there. And in some instances, properties were selling $200,000 and $300,000 above reserve. So there's certainly competition still going to be there because I still think there is some pent-up demand. And I don't think the supply is going to be as strong, I think the values will still continue to hold at reasonable levels, particularly for good quality stock. Yeah, for sure. So I think that's probably the main things. And I think obviously where we focus, that multifaceted demand is I think, really a key at the moment. And I think that's come to the fore and become even more evident during this period that you need to make sure properties that you select for investment purposes particularly need to have that multifaceted demand. There's a question I saw in the chat window there before about what makes a good investment property, and that I think at the moment there's a number of factors. We talk about three key elements typically, but multifaceted demand I think is more important than ever at the moment, and it's been shown through this period that if you've got a number of different buyer types that are interested in that type of property, then it's going to hold it in good stead through a tough time. And I think that's a key thing to be focusing on when you're buying property during the spring market. If it is for investment purposes, then it needs to have not just an investor that would be interested in it. That's an important one, but you want to have downsizers, you want to have upgraders, you want to have first home buyers if they've got the financial capacity. If you've got that sort of thing working for you, that level of competition, it's going to hold that sort of property in good stead, and it's going to mean that when the market does kick again, whether it's in 1, 2, 3 years' time, that's the sort of property that's going to kick first. Yeah. Very good. All right, and is there any other points, Jordan, that you wanted to bring up or talk about before we get into perhaps some question and answer?
Not really. I mean, there's any number of things that we can talk about, but we've got time limitations. Probably one thing though that is important for those looking to buy in spring, not as a word of warning, but be very, if particularly if you're looking to move in as an owner-occupier, be very careful not to be purchasing on the basis of a short-term settlement, so 30, 60 days, if the property is occupied at the moment, is occupied or tenanted, I should say. At least 90 days, preferably 120, because of, well, for starters, I mean, there's financing issues that you might, things might be protracted there, but in order to be buying that property with vacant possession, it might need to go through VCAT, you'd like to think to rubber stamp it, but there will be all sorts of hardship tests. As I've spoken to agents a little while ago, it was a bit of a surprise actually, but it's not necessarily a fait accompli that you'll be able to get access to the property that you bought with vacant possession come settlement, and it might need that that approval at a VCAT hearing to get that. So just to give yourself a little bit of extra breathing space, if a property is tenanted and in a position where it can be bought with vacant possession, so there's not an existing lease, fixed term lease in place, look for longer rather than shorter.
Yep.
Yeah, so that was probably the main point there on purchasing this spring.
Okay. So some of the questions that we had given to us or asked before as part of registration, we'll just try and answer these as quickly as we can so that we can get through a few that have been asked during the chat as well. Pavel said, how do you assess whether property is investment grade without being physically present on site? You can't trust the advertised pictures. I couldn't agree with you more, Pavel. It's not something that I would advise a client to do. There's just too many uncertainties. You can go and physically look at a property, and you might have a list of questions that you know you've asked in the past, and that's met all of your requirements. But when you do a physical inspection, you might see two or three things that perhaps weren't an issue with the other property that you wouldn't have asked about if you hadn't been at the property to look at them and see. So, I wouldn't be advising any client to be buying a property sight unseen. We buy plenty of property for clients who are interstate or overseas, but we look at them. We physically inspect them, and we have at least two of our team members do that. So that would be my comment. I don't know if there's anything you wanted to add to that, Jordan.
Probably the only exception to that is if you're not too concerned about the condition of the property, and it's either going to be a bulldozed in the short term for your own construction, or if you're looking to subdivide, whatever it might be, that's the exception to it. But otherwise, you can't detect rising damp from photos and video walkthroughs. You can't detect the drop away, the significant drop away or sponginess, which might necessitate restumping. Quite apart from the feel of a house, some houses we look at on the floor plan and you go, well, that's not going to work. When you look at the dimensions, but you get through and say, no, well, actually, it actually does work pretty well when you get through it, and vice versa. Some that look fine on paper, you get to the back of the house and you go, it's just not, it doesn't work. The proportions are wrong. It just doesn't stack up.
Right. Yep.
Yeah.
Another one from Liz. When do you think enough property will be listed and to see prices fall? Scarcity has kept the market buoyant in the inner north. Yeah, you would think that if it's a traditional spring, well, we're going to see some significant influx of property over October, probably a later one November. We didn't see it last year though, which kept things pretty buoyant. As much as agents are telling us, look, there's a fair bit there just ready to go, I'd be surprised if we see a traditional spring, if you like. As I said before, those multi-weekends of 1,500 to 2,000 auctions a weekend, I don't think we're going to see that. It might be a case of if that comes about, then it might be autumn next year. But yeah, I don't think we're going to get to that tipping point where it's going to this year, where it's going to see a significant reduction. And if we do see that, it's going to be on the basis, I think, of people that are unfortunately in a position where they just have to sell.
That's my gut feel on it.
Okay, we've got some good questions here from the chat. Romana asked, what impact do you expect on the property market if the ability to work at home continues on an ongoing basis? Effect on the CBD with empty office space and some people choosing to leave Melbourne for regional areas. I've had this discussion on a number of occasions in recent times. I think I guess there's a number of different parts to that, and the commercial space in the inner city is probably not our area of expertise, so I'll leave that for the moment. But more around the lifestyle side of it. So people not wanting to be perhaps in Melbourne and wanting to considering looking at other areas. There'll no doubt there'll be some people that have realised now that they can actually work from home and or perhaps not necessarily need to be in the office as regularly as what they were. And providing their employers or if they're self-employed are comfortable with that, then that's something that they may be able to work around. But is it going to be a drastic change where all of a sudden everyone wants to live in a regional area? It's just not. People, there will be some that will want to change, but the bulk of people want to live in the city for a reason. And there's services, there's lifestyle, there's family, there's friends, there's entertainment, and that suits different people's purposes. But you can't live in Ocean Grove or in Ballarat, Bendigo, Geelong, and be able to jump on a train and within 10 minutes be at the MCG or go to something at the Arts Centre. Or there's any number of reasons that people now. There's others that will prefer to be in regional areas, and so that may, I think, probably more have an impact on values in some of the regional areas, because it doesn't take much for an increase of a few people wanting to go to a regional area to impact on the values there, whereas a few people leaving Melbourne is not necessarily going to have as drastic an impact on property prices. So I think it's more likely to have a positive impact on regional areas than it is to have a negative impact on metropolitan areas.
Yeah, there are certain industries, I suppose, certain features of Melbourne that just aren't going to be replaced, or they're not going to be taken out of the city of Melbourne and moved regionally. If you look at just as a small sector of Melbourne, if you look at Parkville, Carlton, Fitzroy, with the number of hospitals and educational institutions, RMIT, Melbourne University, the world-class teaching hospitals and medical facilities that we've got, well, just in that sector of Melbourne, that's a massive driver. Those aren't going to move. People aren't going to be commuting 200 or 300 k's to go to work there. It's just not realistic. Now, as you said, Jarrod, there will be people, and we all know people that have decided now's the time to make a move, and that's great. And I think for the short to medium term, there will be an element of, well, okay, things are changing. We don't have to be in the office for 5 days, maybe 1 or 2 days, and then commute, and bit of a mix. But to be, as I've read in various places over the last couple of months, to be talking about this as being the death of the CBD, the Melbourne CBD, I just don't subscribe to that. I'm just old enough, I suppose, to remember the recession, when when the manufacturing industry was hit for all sorts of reasons, and everybody was piling out, and it seemed everyone was piling out and going up to Queensland. Great, that's fine, but Melbourne reinvented itself. We found a way through it, and the reverse has occurred with population increases over the last 10, 15, 20 years. It'll happen again. We'll find a way through. It's a great city.
Absolutely. I think that's a very good note to end on. So thanks very much to everyone for joining in today. You will receive a link to this webinar, so feel free obviously to watch it through again, or perhaps forward it on to friends and family or people that you may think will find it useful. Sorry we didn't get to all the questions that were submitted, but if you would like to have a chat to either one of us or any of the other property team members within the company, feel free to let us know. We're more than happy to have a chat. If we can be of any further assistance to you, we'd love to do that. While we're not inspecting properties at the moment, we're certainly available on the phone. So thanks again. Everyone stay safe. Good to see you again, Jordan, and we'll speak again soon.
Thanks, Jarrod. Thanks for involving me.